In a world of financial titans, one company was meant to be king, a giant, striding towards a fabled $1 trillion throne. They held the key to one of humanity's biggest crises, and the market loved them for it. Their stock wasn't just climbing, it was a rocket ship, leaving the entire S&P 500 choking on its dust. Investors who got in early weren't just making money, they were building dynasties. Then it happened. The rocket ship stalled. It shuddered, and then it began to fall. Not a dip, not a correction, a catastrophic, gut-wrenching plunge. Down 15%, down 27%. The single largest, most brutal drawdown the company has seen in 15 years. The trillion-dollar dream? It didn't just die. It was executed in broad daylight for the entire world to see. The company's market cap was sliced nearly in half, a stunning $500 billion bonfire of wealth and ambition. Because while the world was panicking, while Wall Street analysts were slashing their targets, and investors were stampeding for the exits, something else was happening. Something hidden from the headlines. In the shadows, the company's own leaders, the people who know its secrets better than anyone, were staging a rebellion. They started buying, not selling, buying. The director, the executive vice president, even the chairman and CEO, 7 different insiders in just a few days, pouring a staggering $4 million of their own money into the wreckage of their own company. They're not just betting on a comeback, they're sending a flare into the night sky, a signal that the story you've been told, the story of failure and collapse, is a lie. Today, we peel back the layers of that lie. We expose the psychological trap that ensnared the market, and we reveal the secret engine of growth that Wall Street has completely ignored. This isn't just another stock story. This is the anatomy of an opportunity, an emotional journey through fear, greed, and the hidden architecture of a potential comeback so massive it could redefine the entire market. What do these insiders know that you don't? Stay with me and you'll find out. Let's set the stage. The year is 2025. The market is, well, on fire. The S&P 500 has been on a tear, delivering double-digit returns that have made a lot of people very, very rich. Valuations are stretched to their breaking point. Finding a genuine opportunity, a real bargain, feels, honestly, impossible. It's a seller's market, a landscape of sky-high prices where every stock seems overvalued, a gilded trap just waiting for the unwary. And then there's Eli Lilly. In this sea of green, Lilly is a bloody stain. Year to date, while the market roared, Lilly whispered, then screamed as it fell 15%. But that's just the beginning of the nightmare. Look back over the last year, and the picture gets even uglier, a 27% collapse. This isn't just underperforming, this is a public flogging. The company is trading near its 52-week low, a place reserved for broken companies and forgotten relics. We are witnessing the single largest, most painful drawdown this company has endured since 2010. Think about that. A decade and a half of progress, wiped out in a storm of panic selling. And the irony is, well, crushing. It wasn't that long ago that the entire financial world was crowning this company as the next member of the most exclusive club on earth, the $1 trillion market cap club. It seemed inevitable. A foregone conclusion. Today, it sits at just over half that. A giant cut down to size, $574 billion, a shadow of its former glory. So, the question is, why? What could possibly cause a titan of industry to crumble so spectacularly? The official story, the narrative pushed by the media and whispered in trading forums, is simple. It all comes down to a single pill. Eli Lilly was developing an oral weight loss pill, a potential game changer that could have made their revolutionary injectable GLP-1 drugs accessible to hundreds of millions more people. It was supposed to be the next chapter in their world-changing story. The market waited with bated breath for the trial results, and when they came, they were a disappointment. Users lost around 12% of their body weight after more than a year. Now, to you and me, that sounds pretty incredible, but it wasn't enough for the razor-thin expectations of Wall Street analysts. They had forecasted more, and in the brutal world of Big Pharma, if you don't hit your forecast, you don't just get a slap on the wrist, you get punished severely. The stock plunged, the dream died, and the market moved on, leaving Eli Lilly for dead. This is the story everyone knows. It's clean, it's simple, and it's devastating. But what if I told you that story is a smokescreen? What if that disappointing pill was the greatest magic trick Wall Street ever fell for? A misdirection designed to make you look one way, while the real miracle was happening somewhere else entirely. This is our first rehook. The problem is clear. The stock has collapsed because of a failed trial. But the solution isn't what you think. The solution begins with a signal, a $4 million act of defiance from the people who know the company's deepest secrets. This is where the real story begins. The great investor Peter Lynch, a legend who outperformed the market for years, had a famous saying. He said insiders might sell their stock for any number of reasons, but they buy them for only one. They think the price will go up. Now, this isn't just one insider making a hopeful bet. This is a coordinated act. 7 high-level executives dipping into their own savings, their own wealth, to buy up shares in their supposedly failing company. We're not talking about small, symbolic purchases. We're talking a total of $4 million. This is what we call a bullish signal of the highest order. It's an open loop, a question that demands an answer. Why would these people risk their own fortunes on a stock the rest of the world has written off? They know something. They see a chasm between the perception of failure and the reality of their business. They see an overreaction, a market driven by fear, and they are using that fear to their advantage. They are telling us, without saying a word, that the company is on sale. So, we have a fallen giant and a secret rebellion from the inside. But blind faith doesn't move markets. You need proof, you need power, you need an engine. And it turns out, while Wall Street was obsessing over the weight loss pill that disappointed, Eli Lilly was quietly unleashing a weapon of mass disruption that is rewriting the rules of the pharmaceutical industry. This is our second story, the story of a drug you've heard of, but whose true power you haven't grasped. We're talking about Mounjaro. For years, the king of the GLP-1 market, the weight loss and diabetes space, was Novo Nordisk's Ozempic. It was honestly a cultural phenomenon, a financial juggernaut. But just look at what's happening right now. In the latest quarter, for the first time ever, Mounjaro's sales have actually topped Ozempic's. We're talking about $5.2 billion in a single quarter, but the sales figure is only half the story. The truly mind-blowing part is the growth rate. Look at Ozempic. It's growing at a very respectable 44.5% year over year. Impressive, right? Now look at Mounjaro. It's not growing in the double digits, it's growing in the triple digits. This is the midpoint revelation. This is the moment that recontextualizes everything that came before. The market punished Lilly for one perceived failure while completely ignoring an absolute conquest happening in plain sight. This isn't a company in decline. This is a company with a growth driver so powerful it's actively stealing the crown from its biggest rival. And this hidden engine is firing on all cylinders, powering the entire company to heights the market refuses to see. Let's look at the proof. The solution to our second story, the latest earnings report. This wasn't just a beat, it was a demolition. Earnings per share came in at $6.31, shattering expectations of $5.59. Overall revenue, up a staggering 38% year over year. But it gets better. This isn't just mindless growth, it's smart, efficient growth. You know what we love on this channel? Margins, efficiencies. And Lilly is delivering in spades. Gross profit margin up 3 percentage points, operating margin up a massive 11 percentage points. The bottom line, the net income that actually makes it into the bank, up 10 percentage points. Do these look like the numbers of a failing company to you? This is a portrait of a business at the absolute peak of its powers. A company that is growing faster, becoming more profitable, and dominating its most important market. And here's the knockout punch, the ultimate twist. On the very same earnings call where they revealed the so-called disappointing pill data, they did something that really should have sent the stock soaring. They quietly increased their full-year guidance. They raised their revenue forecast by billions of dollars and bumped up their earnings per share expectations. Think about the psychology of that for a moment. They are telling the world, yes, that one trial didn't hit your fantasy numbers, but it doesn't matter. Our core business, the part that actually makes us money, is so unbelievably strong that we're raising our targets for the entire year. The market heard disappointment and, well, panicked. The insiders, on the other hand, heard raised guidance and started buying. This is our third rehook. We have a fallen giant, a secret rebellion, a hidden engine of explosive growth. But can it last? Is the company truly undervalued, or is this all just a sophisticated trap? The answer lies in a war being waged right now on Wall Street, a battle of titans that will decide the fate of Eli Lilly's future. Every great story needs a conflict, and in the world of finance, there is really no greater conflict than a Wall Street war. Right now, analysts are drawing their battle lines over Eli Lilly, and their conclusions could not be more different. On one side of the fence, you have the bears. Cantor Fitzgerald, for example, took a look at the landscape and decided to lower their price target. They see the risks, they see the volatility, and they're urging caution. To be fair, even their lowered target of $825 still represents a significant upside from where the stock is trading today. But the message is clear: be careful. But on the other side of the fence, you have the bulls, and they are charging with ferocious intensity. Morgan Stanley is leading the pack. They haven't just maintained their overweight position, they've reiterated it with thunderous confidence. They're telling their clients that this sell-off is a massive overreaction. They believe the GLP-1 market is a growth driver that will rocket the company to unimaginable heights. Their price target isn't cautious, it's audacious. They believe this company is going to hit over $1,100 a share. And just yesterday, another warrior entered the fray. CNBC, a voice that echoes across trading floors worldwide, gave the company a stunning double upgrade, citing the very same insider buying we've been talking about as a profoundly bullish sign. This is the dramatic tension that defines this opportunity. It's a tug-of-war between fear and data. So let's arm ourselves with the same weapons these analysts are using. Let's look at the numbers, the cold, hard facts that form the bedrock of the bull thesis. This is our third and final story, the valuation. First, let's revisit a powerful but often misunderstood tool, the PEG ratio, the price-to-earnings growth ratio. Think of it as the market's lie detector. It measures the stock's price against its earnings growth. A number around 1 is considered fair value. Lower is better. Higher means you're overpaying for growth. Eli Lilly's forward PEG ratio is sitting at 0.9. Let me repeat that, 0.9. It's below the sector median of 1.9 by a whopping 50%. It's 55% lower than its own historical average. The lie detector isn't just flashing green, it's screaming bargain. Next, let's talk about history. Eli Lilly has always been an expensive stock because it's always been a premium company. Its 5-year average forward PE ratio is a lofty 38. Today, you can buy it for a forward PE of just 24. That is a 34% discount to its own recent history. You're paying significantly less for a company that is, as we've already established, growing faster and more efficiently than it has in years. The picture is almost paradoxical. The business performance is accelerating, yet the valuation is plummeting. And for the technical analysts out there, we have one of the most compelling charts I've seen all year. This is the blue tunnel methodology. It's a way of visualizing a stock's intrinsic value over time. For the last 5 years, as Lilly's stock went on its legendary run, it has consistently traded in the overvalued territory. It was expensive, and everyone knew it. But look at it now. For the first time in this entire period, the share price has plunged deep into the zone of undervaluation. The intrinsic value of the business, represented by the blue tunnel, continues to climb, while the share price has fallen to meet it. This is the classic signal of an opportunity, a disparity between price and value. But a true warrior acknowledges their enemy's strength. The bears have ammunition too. They point to the balance sheet. They'll tell you that free cash flow has been inconsistent. They'll show you that total debt has been creeping up while the company's cash on hand has been decreasing. And they'll highlight that in the most recent quarter, institutions as a whole were net sellers, not buyers. These are not trivial concerns. They are cracks in the armor. They represent the risk, the reason the stock is cheap in the first place. But the bulls have a powerful rebuttal. This is it, the moment of climax. The point where we take all the pieces, the fear, the hope, the data, the drama, and assemble them into a single coherent picture. This is where we deliver on the promise of our hook. The market has been fixated on a single data point, a weight loss pill that didn't meet a forecast. It punished Eli Lilly as if the entire company's future rested on that one trial. This was a catastrophic mistake, a classic case of missing the forest for the trees. They missed the insider rebellion, a $4 million vote of confidence from the people who know the truth. They missed the hidden engine, the fact that Mounjaro and Zepbound are growing at triple-digit rates, conquering the multi-hundred billion-dollar GLP-1 market and dethroning the king. They missed the earnings explosion, the 38% revenue growth and the expanding margins that prove the company is healthier than ever. They missed the confidence of the guidance raise, a clear signal from management that the core business is booming, and most importantly, they missed the staggering valuation discount, a PEG ratio below 1, a 34% discount to its own history, the first dip into undervaluation territory in 5 long years. The market is pricing Eli Lilly for failure, when the reality is a story of explosive success. The institutional selling, well, that's just a footnote compared to the conviction of the insiders. The balance sheet concerns, Manageable issues for a company generating this much cash and growing this quickly, especially with a return on invested capital of a stellar 31%. They're investing heavily in research and development and acquisitions like Verve Therapeutics to build their next generation of growth engines in oncology, immunology, and even gene editing. This isn't a one-trick pony, it's a diversified powerhouse. The bears see the cracks in the armor. The bulls see a titan putting on a new, stronger suit of armor paid for by unprecedented growth. So, what is the final verdict? What is the fair price for this fallen giant? Our own analysis, a discounted cash flow model using a conservative 35% growth rate, well below the 44% average we're seeing, arrives at an intrinsic value of $692 per share. From today's price, that represents a solid upside. But we are not the only ones who see this. Wall Street as a whole, when you average out all the analyst targets, the bulls and the bears, arrives at a price target of $935 per share. That is a potential 40% upside over the next year. And if you believe the super bulls like Morgan Stanley, the destination is over $1,100. To buy the stock today, you have to believe the company can grow at about 34% year on year. Given everything we've seen, the 38% revenue growth last quarter, the triple-digit Mounjaro expansion, the raised guidance, does that sound impossible? To many, it sounds like a starting point. This has been an emotional journey. We started with the chaos and fear of a market collapse. We uncovered a secret rebellion. We revealed a hidden engine of growth. We fought a war on Wall Street with data as our weapons. And we have arrived at our conclusion. The story of Eli Lilly in 2025 is not a tragedy, it's a masterclass in market psychology. It's a lesson in looking past the screaming headlines and reading the fine print. It's about understanding that the market, in its quest for perfection, can sometimes violently overreact to a single flaw, creating a window of opportunity for those who've done their homework. The insiders weren't just buying stock, they were buying fear. They were capitalizing on Wall Street's biggest miscalculation of the year. The trillion-dollar dream for Eli Lilly isn't dead. It was just put on a temporary deep discount. Now, I want to hear from you. Do you believe the insider buying is the ultimate bullish signal? Is this a generational opportunity to buy a titan at a discount? Or is it a value trap with too much risk? Let me know your thoughts in the comments below. And as always, remember that past performance is not an indicator of future results. Do your own research. Thanks for joining us on this journey. Have a great day, and we'll see you on the next